Joining me on the program today is Marin Katusa. He's Senior Market Strategist at Casey Research. And Marin, I want to talk about something that is in the headlines today. There's a Bloomberg story. Israel can't go it alone on Iran nuke strike. You wrote about the petrodollar, and there's a lot of posturing that's going on right now. We've got the Secretary of Defense, Leon Panetta, talking about it's just a matter of time that there is some kind of strike. And they're talking and worried about what is going on Iran developing a nuclear weapon. You have a different take on that because you just got back from Israel. Let's start with what your perception in terms of what this is all about.
First off, I believe that Israel can do it alone, but it's in their best interest not to, and it's also a reason for the Americans to be involved. The potential threat of the Strait of Hormuz to be shut down, first of all, I also do believe that Iran can shut it down, but it's not going to be permanently shut down. It will be a temporary issue, and whether Israel and or the Americans or together want to open it, they will do so. So it is not in the best interest right now for Iran to do that, and a lot of this is lip service and posturing, as you said. So you have to be careful what you're reading in the papers right now.
There's a lot of talk that we're having all these sanctions. You don't believe they're going to achieve their goal because, as you wrote about, Iran has a lot of friends, one of them being China, the other Russia, and even India. But what really gets at the heart of your article, what's really key here from a U.S. perspective, is the petrodollar, because a good majority of dollars traded around the world today are used to purchase oil, because oil's quoted in dollars. So let's talk about the petrodollar. And maybe you might want to tell our listeners sort of a lead up why this is important, because over the last 3 or 4 decades, we quit backing the dollar with gold, but yet the dollar is accepted in universal trade today, but most importantly in the oil trade.
Sure. Let me take you back to 1973, and that's when President Nixon asked the King of Saudi Arabia to accept only U.S. dollars as payment for oil, and then to invest the excess profits from the oil in U.S. Treasury bonds, notes, and bills. And then what happened was, which people are forgetting at the time, if the King of Saudi Arabia did that, the American government pledged to protect the Saudi Arabian oil fields from, at that time, remember, the evil was the Soviet Union and other nations interested in, taking control of the oil fields. So that was the beginning of it. Then, 2 years later, 1975, all of the members of OPEC agreed to sell their oil only in U.S. dollars. So every oil importing nation at that time in the world started saving their surplus in U.S. dollars. So that's the beginning of the petrodollar system. That gives you kind of a brief understanding. And there's been rumors floating around that India now is going to be exchanging gold for oil. Remember, with Iraq in early 2000, there was the Food for Oil program that since has been ended. So there's been attempts by nations to change it or divert the system, but the Americans' key here is to contain this petrodollar, their monopoly of currency for this oil.
Now, in terms of having the dollar used in the oil trade, there are various benefits that accrue to the United States. Number one, a strong dollar allows us to buy imported goods at a massive discount. And also, the petrodollar system essentially created a subsidy for U.S. consumers at the expense of the rest of the world. Now, there seems to be somewhat of a challenge to that dominance, Marin, because you're seeing more and more countries. You're seeing China, for example, do business with Iran in its own currency. You're seeing China do business with Brazil. You're seeing Russia do business. So more and more countries, including India, are moving away from the dollar. Isn't there a risk if more countries start moving away and using their own currency to buy dollars? What does that do in terms of the dominance of the U.S. dollar?
Well, Jim, you laid out a perfect scenario. Basically, what that does is decrease the demand for the U.S. dollar, and the potential threat is lurking in the shadows where the value of the U.S. dollar will be significantly decreased because less of it's demanded because of the trade in U.S. dollars. When Doug and I were down in Kenya, we looked at, certain areas where you wouldn't believe the Asian influence. And there's a lot of barter system going on. Well, we'll build a plant. We'll bring our workers. When Doug Casey and I were in Iraq, the field service system that was doing the 3D seismic, as Doug stated, it looked like out of a film from the 1970s James Bond, where they're all happy and they're all workers and they're wearing their orange overalls. About 100 of them slept in one massive tent just on a piece of foam. There's a major shift happening here, and you're not going to find that on the mainstream press, but it is a potential threat to the value of the U.S. dollar, and which potentially will lead people to want to invest in gold as a backup or as an insurance policy.
Now, prior to this, no country really challenged the concept of using dollars to pay for oil until around 2000, where you had one country, including France and a few others, that convinced Saddam Hussein to defy the petrodollar process and basically sell Iraq's oil and denominate that in euros, not dollars. Then you had other nations hinted at the very same thing. We know that Russia has done it, Iran has done it, Indonesia, and even Venezuela. But Iraq was the start of unwinding the petrodollar, and lo and behold, a couple of years later, we were at war. Correct.
I'm not a conspiracy theorist here, but what I'm saying is, let's look at the facts, and by 2003, America invaded Iraq. And since that point, the food for fuel system that France and a few other EU nations were the spearhead, that ended. Okay, so is it just a coincidence? Perhaps, but the fact is, that's what happened.
Now, if we look at this right now, you are seeing increasingly, it's almost like every couple months you hear a story that this nation just concluded negotiations to buy oil in either euros, yen, Chinese yuan, rubles. Let's talk about the Iranian dilemma, because it is being isolated from the United States and Western Europe with these sanctions. But if Europe doesn't buy its oil from Iran, if we don't buy our oil from Iran, will these sanctions effectively work, Marin, if you have others? Iran is a key resource for energy for China. I don't think China and Russia is going to go along with this.
Well, I don't think so either. You see that it's all about access through the Strait of Hormuz, and that's what this is all positioning. The Navy is positioning itself. Israel is stating themselves ready. And, when we were there, we were on an offshore project, and you can see the presence of the military there in Israel. They're ready for this. This is an important issue. Is Iran developing these nuclear capabilities for weapons? I don't know, but the reality is they're going to use that, just like they did to Saddam Hussein, as a reason to come in. Now, it would be in the worst interest for Iran to actually close the Strait of Hormuz, so it's going to be interesting to see who blinks first, or, who's the catalyst to this potential conflict. But, the odds are against Iran, so it'll be interesting to see. But from a Chinese perspective, they really do not want that strait closed. And, China's been pretty quiet about it all. That's the interesting fact here.
Yeah, because, if you take a look at trade with Iran and China, it's about $30 billion, and it's expected to grow and double over the next couple of years to $50 to $60 billion. And so that's a very important source of energy for China. And like I suppose the United States, China is trying to diversify its source of energy so it's not dependent on one country. So right now, Marin, I live in San Diego, and we have 4 aircraft carrier battle groups based out of San Diego that handle the Middle East and Asia. And right now, every one of our carriers are out of port. We just sent our 3rd carrier battle group to the Middle East. So is this saber rattling in your opinion?
Without a doubt. This is posturing. America's not going to attack unless they are given a reason to attack. And right now, with the situation going, I agree with you. It's just, rattling the boat, seeing what Iran's going to do.
Now, what makes this interesting in terms of not only maybe moving away from the dollar in terms of the petrocurrency trade, you also have many of these countries, China, Russia, that are major producers of gold. What happens if, for example, China produces a lot of gold, starts trading with Iran, and gold is substituted for the dollar. What does that do to the gold market, and more importantly, eventually to the dollar?
Well, what it will do is, let's just take Iran for an example, but remember, you have Venezuela, you have many other OPEC nations that if Iran is successful in doing this, and they're still a long way from being successful, but if they are, if India or even China or Russia trade either food or gold for the oil, then the Iranians are going to have to either borrow from that gold or trade it. But what's going to happen is India or China are going to have to replenish their reserves, and it's not a plentiful reserve, so there's going to be a massive bull market for the gold. And, this hasn't even started yet, and look where gold is. If this does happen, you could see gold go to $2,500, even to $5,000, depending on what happens here. And more importantly, if the Strait of Hormuz does close, even temporarily, you are going to wake up one day and oil will be north of $150 per barrel. That's WTI, never mind Brent, which will be even higher than that. This is a very serious issue.
And Marin, if that was to happen, let's say gold was to take off. In fact, on the day you and I are speaking, gold is up about $25. It's up about 11% for the year, silver over 21%. Is this, in terms of investors planning for this? Because we know little by little, every year, there are more and more countries that are doing bilateral trade outside the dollar. As more and more of this takes place, which is going to be a driver for dollars, and especially as more and more central banks revert to quantitative easing, whether it's Japan, the ECB, or the Fed, it seems to me gold's the natural play here. But along with gold, would gold stocks be a play on this as well? Because they're the companies that produce this stuff. But, Marin, that hasn't necessarily been the case the last couple of years. Bullion has outperformed the stocks.
Not yet, because the general investment universe hasn't accepted the fact that gold is going to go higher. They believe that the economy is going to take off and, it's only the contrarians that are investing in gold. If such a situation happens and gold breaks over 2,000 and stays there, there's a massive paradigm shift. And even the producers, the majors to the intermediate producers to even the juniors who are exploring for the gold, there will be a wave of investment coming in, and that will take these stocks much higher.